Nowadays, inflation creates a much challenging living environment for us, especially for the working class. Some have to rely on credit cards to cover living expenses. According to TransUnion, the average consumer has a credit card balance of $6,088. This is the highest since 2009. Same for the average mortgage payment. It has gone up to $2,605 per month. This is a 20% spike from a year ago. Facing all these challenges, should we pay off debt or invest? Is it possible to earn extra income from investment so we can pay less interest? Let's explore different examples of paying off debt while finding new ways to earn extra cash. A small adjustment could make a huge difference in the future. At the end, we will determine whether you should contribute to a 401k while in debt. First of all, save up enough emergency funds before starting to pay off debt. It is always a good practice to have some funds in your bank account in case unexpected events happen, like car repairs and being laid off suddenly. Without an emergency fund, you might end up accumulating more debt and paying more interest. As a general rule, it is recommended to save up to 6 months of living expenses as an emergency fund. Once all your debt has paid off, life becomes much easier for you. Down the road, you will be able to keep most of your paycheck and accumulate wealth by making smart investments. Depending on the type of debts, some are good to pay off early while others are okay to keep. Suppose you have a $500,000 mortgage for 30 years with a 4% interest rate. Theoretically, you would need to pay $2,387 per month to keep up with the mortgage. After 30 years, the total interest is $359,338. Now, after paying monthly payments, you still have $800 free money on your disposal. Instead of paying the extra $800 towards the mortgage, here is what you can do. Investing in Invesco QQQ Trust Series 1, ticker symbol QQQ, an ETF that has a portfolio of the top 100 stocks in the information technology sector, including Apple, Microsoft, Amazon, and Broadcom. In the past 30 years, the average return of QQQ is 13.84% per year. So, with $800 each month investing in QQQ, you would have $468,941 in the investment after 30 years. In fact, you only invested $288,000 in QQQ over the course of 30 years. After paying off the interest, you can take the difference of $109,603. The amount you put in to invest is less than the total interest you have to pay in 30 years. This is the power of compounding. In this case, the rate of return in investment is much bigger than the mortgage rate. So, it is okay not to pay off such debt early. By investing extra cash in index funds like QQQ, you have a positive return of 9.48% every year. Additionally, these calculations are not factoring in inflation. With a 5% inflation rate, your money would have half of its original purchasing power in 14.4 years. As time goes, your paychecks are most likely getting higher to match the inflation. The amount you always pay is still the same. It is in old dollars. Investing extra $800 per month can take care of the interest and make extra money after 30 years. In early 2024, Forbes advisors reported that the average credit card interest rate is 27.81%. Most credit card rates can change based on the market. For instance, if the Federal Reserve, or Fed, raises interest rates aggressively, like in 2022 and 2023, most rates were moved up, including credit card interest rates. In reality, most investments do not have over 20% return per year. Warren Buffett is a legend in the investment world. All he can do is have an average of 22% return per year in his investment journey. Most people like you and me are not always able to generate 27.81% every year. Even if you could, you would only break even. For example, if you owe $100 to a credit card, you will have to pay back $128 after a year. In contrast, someone as good as Warren Buffett might only make $22 back in a normal year. As a result, it is not worth it to keep credit card debt when investing. These two things should not be happening at the same time. Prioritize paying off debt over anything. Then we can focus on investment. Debts like credit card and home equity line of credit should be paid off as soon as possible. If you are paying the minimum amount every month during a prolonged period of interest rate hikes by the Fed, you might end up having a constant balance on your credit card debt. Another good reason for you not to hold on to your credit card debt is because it may affect future loans or mortgages. Whenever you need to finance a new car or take a mortgage for a house, financial institutions are not only seeing your credit score, but also checking your debt-to-income ratio. It is using the monthly debt you have divided by the gross monthly income. Let's say you are paying $400 for a car loan every month and your monthly salary is $2,000. Now your debt-to-income ratio is $400 divided by $2,000 would be 0.2, which is 20%. You want to keep this ratio as low as possible. The higher the ratio, the harder you can finance what you want. As a rule of thumb, this number should be under 30%. There is a chance that financial institutions don't approve your request when they see your debt-to-income ratio is too high. Even if your loan or mortgage is approved, you may end up paying much higher interest. The extra money you pay can easily add up. Sure, you don't want that to happen. Paying off debt as fast as possible can get you a much better credit score. Finally, should we still invest in 401k when in debt? The answer depends. Let's say you have a 30-year mortgage. Your employer offers a 5% match for your 401k. If you don't have a lot of other expenses, it is best to contribute at least 5% of your paycheck to 401k. Here is why. Let's say your 5% is $300. Right away, your employer contributes $300 to your 401k, which would make it $600 as a monthly contribution. Your initial investment has doubled even before you start investing. This is a 100% in return. If you keep investing down the road, you can easily gain at least 8% return per year from S&P 500 of what you and your employer put in. When in an emergency, you really need to take out some money. After a 10% penalty, you can still take out more money than you originally contributed to deal with challenges. Another situation is having credit card debt. In the current situation, the interest rate could be as high as 20% to 30%. It is the best of your interest to pay off the debt. The debt is like a snowball as well, but it just is not in your favor. With over 20% of interest, it accumulates really fast. Once your debt has paid off, you will relieve a lot of stress. Now it is the time to participate in 401k with your employer match and Roth IRA. Whether to invest or pay off debt really depends on your unique situation. There is no one-size-fits-all answer. Generally speaking, you can just pay the monthly payment for debts with 5% or lower and invest the rest of available funds. For anything higher than 5%, you may want to pay off as early as possible. The stock market can offer investments with potential returns of 8% or higher, making it an attractive option for growing your money. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See ya in the next video.